Frankfurt's skyline has an aura of poise and power. But behind the glass facades, bankers are quarreling over what led to the current crisis, and even more important, how to master it. Analyst Halver of the Baader Bank has been a stock market professional for years. He tells visitors how things work on the floor of the Frankfurt Stock Exchange. But now he isn't so sure of that himself. And he's unsure what a long-term solution would look like. But he thinks one thing is clear.
Banks' risk capital has to be limited. Banks can't be allowed to finance things entirely externally. They should have to hold a certain percentage in reserves. That will make them more careful instead of exporting risks all over the world without keeping any of them on their own books.
To make banks share in the risks in what they sell, regulatory instruments are needed. The European Central Bank, the ECB, has called for more rigorous rules for the financial industry. But the ECB has no real power. Individual European countries are still in charge of the supervision of the financial markets. But Franz-Josef Leven, the director of the German Equities Institute, agrees that new regulations are necessary. He says banks have been selling products that they themselves don't understand.
I can imagine that there will be a new kind of regulation aimed at transparency, not at permits or things like certification. Things will happen in some places so that one is better informed about what is currently happening on the market.
But other voices warn that too many regulations will strangle the market. Regulation may be needed, but not too much of it.
When introducing regulations, we have to be careful, because regulations can also trigger such crises. Because in the long term, they hinder the market, and a functioning market is exactly what we need right now.
But everyone agrees that every market needs some regulations. And they ought to apply to all of Europe. At least that's what leading financial experts are calling for. They say it's time to harmonize financial policy across the European Union.
It's not enough to have a common monetary policy. In Europe, we need strong coordination and integration of the financial markets as well, because Europe, which is the world's biggest market, is not adequately networked yet.
The long-term therapy is supervision of bankers all over Europe, but it could take years before that functions properly. To treat the symptoms now, the market has to be steered into calmer waters, so that Frankfurt's financial industry can regain its composure.